Every day, someone opens a trading account convinced this is the way out. A laptop, a strategy, a few green trades. The proof is everywhere. Screenshots, lifestyle posts, 23-year-olds claiming 6 figures from a phone. It feels real. It feels inevitable. But regulators across every major jurisdiction report the same figure. Between 74 and 89% of retail traders lose money. Not because they are reckless, because something in this system is designed to ensure they do. And someone profits every time. Understanding how means starting where every losing trader starts, with a dream that felt completely real. A trading account opened with hope can become a secret burden almost overnight. For Composite A, the first major loss arrived quietly. Just a sharp dip on a chart, a margin call, and then the balance was gone. The screen flashed red. The broker sent a routine notification. But behind the numbers, something heavier settled in. In the privacy of his journal, the entries stopped. Days passed in silence. There was no message to family, no post in the trading group, only the quiet erasure of screenshots that once promised a breakthrough. The loss was not just money. It was the collapse of a private conviction, the feeling that, with enough effort, he could beat the odds. Instead, the broker's dashboard now showed 0. Payment receipts from the last course, the last signal group, stacked up in his inbox. Each one a reminder. The next try would cost more. Shame made it hard to talk about. Friends knew he was trading, but not about the blown account. The Discord group, once a place for sharing wins, became a place to lurk and watch others post green days. The urge to recover, to get back to even, grew stronger. But the next attempt began quietly, with another deposit, another promise to be more careful. The cycle restarted. New login, new hopes, new risk, always alone with the aftermath. This pattern, silent losses, hidden payments, the refusal to admit defeat, repeats in thousands of private journals and deleted chat logs. The dream of trading as escape turns for most into a private reckoning. The question lingers, if so many experience the same pain, what is it about this system that makes loss feel so personal and so isolating? The shortcut is everywhere. It's the voice in a YouTube pre-roll promising to turn $100 into $1,000 by Friday. It's the Instagram reel showing a rented sports car, a phone with green profit numbers and a caption that reads, "Quit your job, trade full-time." The marketing persona is easy to recognize, even behind a dozen anonymous usernames. The language is always urgent. Phrases like, "Don't miss out. Only a few spots left. My students are making money while you are still at work." The promise is simple: freedom, speed, and escape. No more bosses, no more limits, just a fast track to a new identity. Cool. The images are aspirational: rooftop pools, city lights, a laptop on a beach. The copy leans into the idea that ordinary life is a trap and trading is the exit. Every line is engineered to make the dream feel just out of reach, but only for those who hesitate. The details rarely change. Instant profit, easy withdrawals, proven strategies that require no experience. The hook is always emotional. You are missing out. Others are getting rich. The opportunity window is closing. The marketing voice never mentions risk, only reward. Even the warnings when they appear are buried in fine print, far from the bold headlines. The message is repeated across Discord groups, Telegram channels, and TikTok feeds. The same screenshots circulate. The same testimonials are recycled. The shortcut is not just a sales pitch. It is a story about transformation. The beginner is cast as the underdog, the doubter, the one who needs to believe. The marketer becomes a guide, offering a hand out of mediocrity. This is not just advertising. It's a system that monetizes hope and urgency. The faster the promise, the more credible it sounds to someone desperate for change. The emotional pull is so strong that the dream feels real, even when the results never arrive. The marketing script is designed to bypass skepticism, to turn a private longing for freedom into a purchase, a deposit, a leap. And in that leap, the cycle begins again. The numbers are not hidden in the fine print. Across Europe, the official risk warning on every broker's website reads the same. Between 74 and 89% of retail accounts lose money on leveraged trading products. This range is not an estimate. It is a requirement, mandated by the European Securities and Markets Authority and adopted by national regulators from Germany to Cyprus. In the United Kingdom, the Financial Conduct Authority demands even more transparency. 76% of retail contract for difference clients lost money last year, a figure that must be displayed on every regulated broker's homepage. Australia's securities regulator ASIC recently published its own sector review. The outcome was nearly identical. 68% of retail contract for difference traders ended the fiscal year in the red, with total losses approaching $500 million Australian dollars. These disclosures are not outliers. They are the baseline. Germany's BaFin regulator tracked over 500,000 turbo certificate investors across 5 years and found that 74.2% lost money, with average losses exceeding €6,000 per person. Even in countries where explicit loss rates are not published, such as Japan and Canada, the risk warnings echo the same message. For retail traders, the odds of loss are overwhelming. No matter the jurisdiction, the product, or the year, the pattern repeats. The loss band stays above 70%, whether leverage limits are tightened or broker disclosures become stricter. Regulation has forced the industry to admit, in plain language, that most retail accounts do not survive. The question is no longer whether this is a fluke or a few unlucky traders. The evidence shows a system where losing is not the exception, but the rule. The numbers on a trading dashboard are only half the story. The real accelerant is leverage, the tool that turns a cautious loss into a full-scale wipeout, often in minutes. For Composite A, the urge to recover after a loss didn't just mean trying again. It meant doubling down, increasing position size, opening trades with borrowed money that multiplied both hope and risk. This is where psychology and product design collide. Leverage isn't just a feature. It's the mechanism that makes emotional reactions so costly. A 1% move against a position at 10-to-1 leverage erases the entire account. That's not theory. It's the math enforced by every margin call. The trader puts up $1,000, controls $10,000, and a single percentage point drop wipes out the deposit. The broker's system liquidates the position automatically, often before the trader can react. The loss feels personal, but it's the result of a rule written into the platform's code. This is how revenge trading takes shape. The initial loss triggers a need to prove something, to get back to even. But the only tools at hand are bigger bets and more leverage. Each new trade carries the weight of the last defeat, and the next margin call comes faster. The process feels like a test of willpower, but it's really a test of arithmetic. The emotional spiral is matched step for step by the speed of account erosion. For every trader who tries to recover, the system is ready. The structure rewards urgency, not patience. Leverage turns a moment of frustration into a total reset. The cycle repeats, with each round leaving less room for recovery and more for regret. Every trade is a transaction between hope and cost. But most traders never see the slow leak beneath the surface. The obvious losses, the sudden margin call, the wiped account, draw all the attention. Yet for many, the real drain is quieter. A daily bleed that erodes capital, trade by trade, even when the market barely moves. The mechanism is simple, built into every platform. Each time a position opens, the broker charges a spread, the difference between the buy and sell price. On major currency pairs, this might be less than a pip, but over dozens or hundreds of trades, the spread becomes a steady tax on every decision. For those holding positions overnight, another fee appears, the swap or overnight funding rate. This charge, often a fraction of a percent, accumulates each day, quietly eating into gains or deepening losses, especially on leveraged accounts. Then there is slippage, the gap between the quoted price and the actual execution. In fast markets or around news events, slippage can turn a planned exit into a larger loss or a small win into a break-even trade. Add in occasional inactivity fees or premium data charges, and the cost structure becomes a maze with no exit for the impatient. Even skilled traders, if they overtrade, find themselves fighting a tide of small deductions. The math is relentless. A trader who wins half their trades but pays the spread, swap, and slippage on every round can lose money even without a single dramatic blowup. The losses are not always spectacular, but the erosion is constant. The system is designed to reward volume, not patience. For most, the account balance does not collapse in one day. It fades, quietly, until hope is gone. The most visible trading content online is not an accident of popularity. It is the result of how platform algorithms decide what matters. Social media feeds are engineered to reward posts that generate strong reactions, fast clicks, and longer watch times. In a 2026 audit of Meta platforms, nearly half, 46.78%, of finance-related ads were flagged as high risk. These were not the ads warning about risk or teaching caution. Instead, they promised certainty, speed, and easy profits, often without the required disclaimers. The more confident and compelling the claim, the more the algorithm pushed it to the top of the feed. Content that radiates certainty, such as earn $1,000 in a day. No experience needed. My students quit their jobs is systematically favored over anything that mentions risk or patience. The platforms are not neutral hosts. Their recommendation engines act as amplifiers, making hype and urgency seem like the norm. This structural bias distorts perception. The loudest, most confident voices appear everywhere, while more measured or realistic perspectives are buried. For a beginner, the constant stream of bold promises creates the illusion that quick wins are common and that caution is for doubters. The result is a digital environment where the odds are not just hidden. They are actively inverted by the very systems people trust for information. Trust is the invisible currency that powers the finfluencer economy. For young adults, the relationship with online creators runs deeper than just entertainment. In the latest Financial Conduct Authority survey, people aged 18 to 35 are twice as likely to trust financial advice from a social media personality as from a traditional advisor. The reasons are as much about psychology as about content. Influencers speak in plain language, share personal stories, and present themselves as peers, relatable, direct, and always online. The distance that once separated expert and audience has collapsed, replaced by a stream of posts that feel like private advice. This trust gap is not subtle. In the FCA's 2024 findings, 62% of young adults reported trusting finfluencers, while only a tiny fraction named banks as their main source for financial information. The effect is amplified by the way platforms reward engagement. A creator who shares screenshots of trades, answers questions in real time, and posts daily updates becomes a familiar presence, a voice that feels more accessible than a faceless institution. The conversion from follower to customer happens quietly. A swipe, a click, a sign up through an affiliate link. What begins as curiosity turns into commitment, shaped by a sense of belonging and the belief that someone just like you has already made it work. In this environment, trust is not just a feeling, it is the lever that moves money, often before skepticism has a chance to catch up. Regulators have not watched this unfold in silence. In the United Kingdom, the Financial Conduct Authority moved beyond warnings and issued 38 formal alerts targeting misleading trading promotions, public notices that flagged content for omitting risk disclosures or exaggerating profit claims. Behind the scenes, 20 influencers were interviewed under criminal caution for breaching financial promotion rules. These interviews are not routine. They signal the start of criminal investigations, with penalties that can escalate from fines to bans. In Australia, ASIC followed with a wave of warning notices to 18 social media creators and joined a global week of action, working alongside 17 other regulators to coordinate enforcement. The crackdown is not limited to individuals. Platforms have been pressured to remove non-compliant posts and tighten their own review processes. In one high-profile case, more than 1,000 illegal adverts were taken down after regulators intervened. Yet even as enforcement actions multiply, the underlying incentives remain. The business models that reward aggressive promotion and high-volume trading are intact. Official concern is clear, but the ecosystem that profits from urgency and loss continues to operate, adapting quickly to new rules and shifting its tactics with every regulatory bulletin. The sales funnel behind retail trading is built with precision. Free content, including YouTube videos, TikTok clips, and Discord invites, serves as the entry point, each item crafted to capture attention and build trust. But the real business begins when a viewer clicks an affiliate link. For every new funded account opened, the influencer or promoter receives a fixed payout, a cost per acquisition, sometimes as high as $300 in mature markets. The next layer is revenue share, a percentage of every spread, commission or fee the client generates, paid out for as long as the trading continues. Hybrid deals, upfront cost per acquisition plus a trailing revenue share, tie the promoter's earnings to both volume and churn. Key performance indicators inside brokerage sales teams are not measured by client success, but by new account openings, trading frequency, and reactivations. The more a client trades, the more everyone in the chain is paid. The system is designed so that every failed attempt, every new deposit, is not just a loss for the trader. It is a revenue event for the funnel. A new kind of test now draws in those searching for a second chance. The prop firm challenge. The rules are clear, but unforgiving. Reach a 10% profit target within 30 days. Never breach a strict daily loss cap, and do it all under the clock. Every failed attempt triggers a reset fee, often $100 or more, paid before another try can begin. The business model is built on these cycles. For the firm, each failure is a revenue event, not a setback. The trader, under pressure to perform quickly, faces a dilemma: play it safe and risk missing the target, or push harder and risk instant disqualification. This engineered urgency turns the evaluation into a psychological trap, where the odds of passing shrink with each rush decision. The longer the streak of resets, the more the challenge becomes a treadmill, profitable for the platform, exhausting for the hopeful participant. Survivors in this world rarely go viral. Their habits are quiet, almost invisible in a culture built on speed and spectacle. The traders who last do not chase every signal or double down after a loss. They keep leverage low, rarely above 10 to 1. Most risk just 1% of their capital on a single trade, accepting that any outcome, win or lose, is just one step in a longer process. Their journals are filled with notes about process, not profit targets. They trade only a handful of markets they know well, ignoring the noise of every new asset that trends online. Days often pass without a single trade. For them, patience is not a slogan, but a daily discipline. There are no rented cars, no screenshots, no urgent calls to action. The account grows slowly, sometimes barely at all, but it survives. In a system designed to reward volume and urgency, the survivor's advantage is not brilliance or luck, but the willingness to do less, risk less, and wait longer than most are willing to bear. The real benchmark is not a single big win, but the ability to keep showing up when the excitement has faded. Right now, over 70% of retail traders lose money in leveraged markets, not by accident, but by design. The system rewards urgency and spectacle, while patience and skepticism rarely trend. Algorithms and incentives shape behavior long before any strategy matters. The line between learning a craft and selling a fantasy remains razor thin. So, who truly benefits? And what does that say about the freedom being sold? Share your thoughts below.